The WNA Global Equity Composite was established in 2016 and has been compiled from the returns of all non-taxable accounts over $1 million with a 100% equity objective. This is a new composite that was previously marketed by WNA. The following accounts are excluded. 1. Any account that contains unmanaged assets. 2. Any account that is under $1 million. These accounts are added to the composite at the end of the month that the value meets or exceeds $1 million. 3. Any account that is not invested in accordance with the WNA Global Equity Model, i.e. large cash positions on new accounts, addition of non-equity components, etc. Accounts remain in the composite until asset withdrawal reduces the value under $1 million, unmanaged assets are brought in, or the investment objective of the client is altered. Past performance for these accounts remain part of the composite, and the account is withdrawn at the beginning of the month when the change occurs. The net returns listed reflect the actual management fees charged to the composite accounts. These fees vary according to the account size and fees paid for related accounts. The net return also reflects the reinvestment of dividends and other earnings in the composite accounts, whether as cash or in the original investments. As is the case with all investments, the potential for profit is accompanied with the possibility of loss. A description of the equity indexes listed for comparison in the table provided in the presentation are provided herein. The S&P 500 is considered a broad index for the equity market, seeking to represent the returns of the top 500 publicly traded companies. The MSCI EAFE is a market capitalization weighted index, maintained by Morgan Stanley Capital International, MSCI, which includes a selection of stocks from 21 developed markets, but excludes those from the U.S. and Canada. The Russell 2000 is a small-cap stock market index of the bottom 2,000 stocks in the Russell 3000. It is the most widely quoted measure of the overall performance of the small-cap to mid-cap company shares. The MSCI Emerging Markets Index is a market capitalization weighted index maintained by Morgan Stanley Capital International, MSCI, designed to measure the equity market performance across 23 emerging markets, EM. The MSCI ACWI Investable Market Index represents more than 9,000 securities across large, mid, and small cap size segments, and across style and sector segments in 46 developed and emerging markets. The WNA Global Fixed Income Composite was established in 2016 and has been compiled from the returns of all non-taxable accounts over $500,000 with a 100% fixed income objective. This is a new composite that was previously marketed by WNA. The following accounts are excluded. 1. Any account that contains unmanaged assets. 2. Any account under $500,000. These accounts are added to the composite at the end of the month that the value meets or exceeds $500,000. 3. Any account that is not invested in accordance with the WNA Global Fixed Income Model, i.e. large cash positions on new accounts, addition of non-fixed income components, etc. Accounts remain in the composite until asset withdrawal reduces the value under $500,000. Unmanaged assets or non-modal assets are added, or the investment objective of the account is altered. Past performance for the accounts remain part of the composite, and the account is withdrawn at the beginning of the month when the change occurs. The net returns listed reflect the actual management fees charged to the composite accounts. These fees vary according to the account size and fees paid for related accounts. The net return also reflects the reinvestment of dividends and other earnings in the composite accounts, whether as cash or in the original investments. The composite may or may not be the actual allocation determined to be appropriate for any individual client, and a client may or may not follow the composite. Clients with the allocation shown may have different results based on capital flows, timing of rebalancing decisions, fees charged, or other factors. As is the case with all investments, the potential for profit is accompanied with the potential of loss. The index used for comparison is the Barclays Capital Aggregate Bond Index. It is a broad range index that represents the total return of the bond market. It covers most U.S. traded bonds and some foreign bonds traded in the U.S. The index information is supplied to WNA by a third-party quotation service. Investors should note that investments cannot be made directly into this index. The Leuthold presentation is not a solicitation or offer to buy or sell securities. The Leuthold Group, LLC provides research to institutional investors. It is also a registered investment advisor that uses its own research, along with other data, in making investment decisions for its managed accounts. As a result, the Leuthold Group, LLC may have executed transactions for its managed accounts and securities mentioned prior to this publication. The information contained in the Leuthold Group LLC research is not, without additional data and analysis, sufficient to form the basis of an investment decision regarding any one security. The research reflects the Leuthold Group LLC's views as of the date of publication, which are subject to change without notice. The Leuthold Group LLC does not undertake to give notice of any change in its views regarding a particular industry prior to publication of their next research report covering that industry in the normal course of business. The Luthold Group LLC may make investment decisions for its managed accounts that are inconsistent with, or contrary to, the views expressed in current Luthold Group LLC reports. Wheaton Investors LP, Wheaton & Company LP's parent company, owns 22% of Luthold Group's securities. A managing director of Wheaton & Company LP is a member of the Luthold Group LLC Board of Directors. Wheaton & Company LP, member FINRA, NASDAQ, and SIPC.
All right. Thanks, Kathy. I'm going to pick the Smiths up now and remind you how we can find them alpha through charitable giving. So they're 66 years old, okay? Important things to know about the Smiths. This year they've had a big income windfall to cause their income to go up. Just think maybe they've gotten a big bonus or something like that. And because of that income windfall, their tax bracket has now gone up to the highest federal tax bracket of 39.6%. In retirement, we're estimating them that their tax bracket to go down to about 25%. So 39.6% right now, 25% after retirement. Another important thing to remember about the Smiths, they've always been very charitably inclined. They've always supported their favorite charitable causes, and they want to keep doing that throughout retirement. Finally, like probably most people in this room, they think the United States government gets absolutely more than enough of their money. So, how can we help them generate alpha? And before I keep going, let me just say this. Even if you're not in the 39.6% bracket right now, the concepts I'm about to go over will be relevant to you. All that matters is that you're going to have a lower tax bracket down the road than you have today. So stick with me even if you're not in the 39.6% bracket. So the bad news for the Smiths situation is, since they're in the highest tax bracket, for every additional $100 that they earn, $39.60 is going right back out to the United States government. Not a good thing. The good news about the Smith situation is that for every $100 of deductions that they're able to take, that's the amount that's going to the federal government will go down by $39.60. So here's how we can do some strategic charitable gift planning through a vehicle known as a donor advised fund. What we can do is what's called pre-fund multiple years of retirement charitable contributions today. And you can see on this graphic right here, what happens with a donor advised fund is you give money to the donor advised fund today, and you receive that tax deduction right now. But more importantly, you do not have to give the money to the charity until down the road in retirement. So give money today to the donor advised fund and get your deduction. Wait and give the money to charity in the future. So you might ask yourself, what's the big deal? Why is it so important to do this strategic charitable gifting and pre-fund multiple years retirement contributions today? Let me show you some math and it'll help crystallize the answer. So right now, because of their income windfall, the Smiths have adjusted gross income of $800,000. Now they also have non-donor advised fund itemized deductions of $50,000. So maybe that's property taxes, mortgage interest, other charitable contributions they've already done of $50,000. If they do nothing else this year, you can see what their federal tax bill will be. Almost $250,000 is going to the United States government. What if they take $50,000 and put it in the donor advised fund? Their tax bill goes down by nearly $20,000 just by making that one decision. What if they put $100,000 in the donor advised fund? Tax bill goes down by nearly $40,000. And finally, if they put $150,000 into that donor advised fund, their tax bill goes down by $59,400. That is some significant alpha they have found just by making that one decision. Okay? But we're not done saving on the taxes. The next decision that the Smiths need to make is, what do I put into the donor advised fund? So do I write a check to the donor advised fund? Maybe that's all they've done to their various charities throughout their life and give cash? Or do they consider giving appreciated securities? Maybe they give their W&A investment funds to that donor advised fund. This is why we would suggest giving appreciated securities. Just assume they have two different mutual funds, each worth $75,000, each with different gains embedded inside of them. Remember, they're in that high income tax bracket. So their long-term capital gain tax rate is 20%. You throw the 3.8% Obamacare surtax on top of that, and if they were to sell their mutual funds today to get the cash, they are going to owe 23.8% tax on the gains inside the mutual funds. However, if they give the funds to the donor advised fund, They're giving away those embedded capital gains of $45,000, and they, more importantly, are giving away the nearly $11,000 of taxes associated with those gains. So that's nearly $11,000 more of alpha that they've been able to generate. So let's review what we've been able to do for the Smiths. Just by giving $150,000 to the donor advised fund, $60,000 almost of alpha generated. Then by deciding to give securities instead of cash, we've been able to generate another almost $11,000 of alpha for a total alpha found on this decision of over $70,000. And that is, to meet their goal, $70,000 less dollars going to the United States government. So take the $68,000 of Social Security alpha that Kathy found, add it to the $70,000 of alpha we've been able to find from strategic charitable gifting, and this is nearly $140,000 of alpha we found for the Smiths. And the best part about this is the markets had absolutely nothing to do with this return that we were able to generate for them.